Hello and welcome. Today we are going to unlock the secrets of one of the most influential financial assets of our time, oil. This natural resource not only powers the engines of our cars, but also drives the global economy. More than just a fuel, oil is a powerful tool for investing, trading, and managing financial flows. In this video, we will look at why oil is still the most important energy resource and financial asset on the planet, and how it affects currency rates, stock prices, and the macroeconomics of entire countries. Let's begin our journey into the world of finance. History of the discovery and use of oil. Even in ancient times, people noticed that oily substances sometimes appeared on the surface of the earth and burned. These natural oil deposits were used for lighting, treating wounds, and even in construction. Archaeologists find evidence of the use of oil in ancient civilizations such as Egypt, Greece, and Rome. During the Middle Ages, oil continued to be used on a limited basis. It was used in medicine, for lighting, and for military purposes. For example, Greek fire, a mixture of oil and other substances, was used by the Byzantine army to defeat enemies. The real breakthrough in the use of oil came in the 18th and 19th centuries. In 1859, American entrepreneur Edwin Drake drilled the first successful oil well in Pennsylvania, USA. This event marked the beginning of the oil rush and led to a rapid increase in the number of oil fields around the world. Today, oil is the primary source of energy for most countries in the world. It is used to generate electricity, heat homes, power vehicles, and for many other purposes. Petroleum products also play an important role in the chemical industry, fertilizers, medicines, and building materials. Oil types in major producing countries. Brent crude oil. This is a light type of crude oil produced in the North Sea. Brent crude oil is an international benchmark, light oil grade used to determine oil prices in the European market. It is characterized by low sulfur content and medium density. West Texas Intermediate, WTI. This is a light crude oil produced in Texas, Oklahoma, and Louisiana. WTI is the second most important global standard after Brent. It is known for its low sulfur content and lightweight, making it ideal for refining into gasoline and other light petroleum products. Urals is a heavy type of crude oil produced in Russia. It contains more sulfur and is heavier than Brent and WTI, making it more difficult to refine. Urals is the primary grade of Russian crude oil and is often priced at a discount or premium to Brent. Dubai and Oman are the main suppliers of heavy crude oil in the Persian Gulf. This type of oil is heavier and contains more sulfur than Brent and WTI. It is priced based on agreements between major producers in the region. Saudi Arabia is the world's largest oil producer. The country specializes in heavy grades such as Arab Light and Arab Heavy. Saudi Aramco is a state-owned oil company that controls most of the country's oil production. Russia is a major oil producer specializing in heavy grades such as Urals. Russian oil is produced primarily in western Siberia and the Volga region. Major Russian companies include Rosneft and Lukoil. The United States is the third largest oil producer in the world. The main fields are located in the state of Texas and North Dakota. In recent years, the U.S. has increased its production of shale oil, making the country one of the largest producers of light crudes such as WTI. The United Arab Emirates, UAE, specializes in the production of light crudes such as Murban. The UAE is a member of OPEC and plays an important role in setting world oil prices. The type of oil in the producing country play a key role in shaping oil prices. Light oil such as Brent and WTI is easier to refine and in high demand, making it more expensive. Heavy crudes such as Urals and Dubai, Oman contain more sulfur and require additional processing, making them cheaper. Producing countries such as Saudi Arabia, Russia, and the United States play a leading role in the global economy and control large volumes of oil production. Oil supply and demand analysis. Oil demand is driven by several key factors. Economic growth. During periods of economic growth, the need for energy increases, which in turn increases the demand for oil. This is especially true in developing countries such as China and India, where rapid economic growth is accompanied by increased energy consumption. Transportation. Road, air, and sea transportation are major consumers of oil. Increased automobile and air travel leads to increased demand for oil. Climatic conditions. Cold winters and hot summers increase the need for heating and air conditioning, which also increases oil demand. Alternative energy sources. The development of renewable energy and electric vehicles could reduce the demand for oil in the long run. The supply of oil is affected by the following factors. Production. The major oil producers are the Organization of Petroleum Exporting Countries, OPEC, Russia, the United States, and Canada. The level of oil production in these countries determines the total supply in the market. Investment decisions. Decisions by companies and governments to invest in new field development and infrastructure, upgrades affect oil production. Geopolitical factors. Conflicts, sanctions, and political decisions can significantly alter the supply of oil on the world market. For example, sanctions against Iran or Venezuela could reduce their ability to export oil. Technological innovation. The development of new extraction techniques, such as hydraulic fracturing, fracking, can increase the supply of oil. The balance of supply and demand determines oil prices. When demand exceeds supply, prices rise. When supply exceeds demand, prices fall. OPEC, which regulates oil production by its members, plays an important role in maintaining this balance. Oil exchange trading. Oil exchange trading is a complex system of buying and selling futures contracts that attracts participants from around the world. Oil is traded on the world's leading exchanges, such as the New York Mercantile Exchange, NYMEX, the London International Financial Futures and Options Exchange, LIF, and the Moscow Exchange. A futures contract is an agreement between two parties to buy or sell a certain amount of oil in the future at a predetermined price. The buyer agrees to buy, and the seller agrees to sell a certain amount of oil within a specified period of time. These contracts attract investors from around the world who want to profit from changes in the price of oil. The main participants in oil exchange trading are producers, oil-producing companies that sell oil to generate revenue; consumers, companies that use oil to make products or provide services; speculators, investors who seek to profit from changes in the price of oil; hedgers, companies and organizations that protect themselves from the risk of changes in oil prices. Oil trading takes place in real time on electronic trading platforms. Participants place orders to buy or sell futures contracts, specifying the desired price and volume. When the buyers and sellers' bids match, the transaction is completed. There are two main types of oil futures contracts. Physical contracts provide for the actual delivery of oil to the buyer. Non-delivery contracts, used for speculation and hedging purposes only, without physical delivery of the commodity. The exchange trading of oil is strictly regulated by government agencies and exchanges. This includes monitoring compliance with trading rules, preventing market manipulation, and ensuring transparency of transactions. Oil prices can change significantly in a short period of time. They are affected by factors such as the geopolitical situation, weather conditions, oil inventory levels, and OPEC decisions. This volatility makes oil trading attractive to speculators, but it also increases risks for market participants. Oil exchange trading plays an important role in the global economy, offering participants the opportunity to capitalize on price changes and protect themselves from market risks. This market is characterized by high volatility and strict regulation, making it a complex but interesting market to participate in. Hedging and speculation in the oil market. Hedging is a strategy used to protect against unwanted changes in oil prices. Companies in the energy sector often use hedging to minimize the risk associated with changes in oil prices. There are several types of hedging. Futures contracts. A company can enter into a contract to buy or sell a certain amount of oil in the future at a fixed price. This allows the company to lock in the current price and protect itself from potential price fluctuations. Options. An option gives the right, but not the obligation, to buy or sell oil in the future at a specified price. This allows the company to hedge against unfavorable price changes while still being able to take advantage of favorable conditions. Swaps. Swaps allow companies to exchange cash flows tied to oil prices. This can be useful for stabilizing revenues and expenses. Speculation is an attempt to profit from changes in the price of oil without having physical access to the commodity itself. Speculators buy and sell futures contracts, options, and other derivatives in anticipation of price changes. They are not interested in the actual delivery of oil, but rather in profiting from price differences. There are different types of speculators. Trend followers. These speculators follow the trend in the market, buying assets when prices rise and selling when they fall. Counter-trend followers. Counter-trend traders bet that the current trend will change. They buy when prices fall and sell when prices rise. Scalpers. Scalpers make many short trades throughout the day to take advantage of small price changes. Oil price changes? Oil price peaks and troughs are important moments in the history of the global hydrocarbon market, reflecting extreme price fluctuations caused by various factors such as geopolitical crises, economic downturns and recoveries, and changes in supply and demand. During the global economic crisis in 2008, oil prices surpassed $100 per barrel for the first time. The price reached an all-time high of approximately $147 per barrel in July 2008. This peak was driven by high demand for oil from rapidly growing economies such as China and India, as well as geopolitical tensions in the Middle East. The COVID-19 pandemic in 2020 led to a sharp drop in global oil demand as many countries imposed quarantine measures, reducing transportation and industrial activity. In April 2020, WTI crude oil prices actually turned negative, reaching minus $37 per barrel, meaning sellers were effectively paying buyers to take the oil. Impact of oil on other financial assets. The price of oil is closely tied to the currencies of countries that export and import the commodity. When oil prices rise, the currencies of exporting countries strengthen because they receive more revenue from the sale of oil. For example, the Russian ruble and the Saudi rial may appreciate when oil prices rise because these countries are large exporters. Conversely, the currencies of importing countries such as India and China may weaken when oil prices rise because they have to spend more to import the resource. This can lead to trade deficits and weaker economic performance. The stocks of companies in the energy sector are very sensitive to changes in oil prices. An increase in oil prices usually leads to an increase in the share price of oil companies as their revenues and profits rise. For example, the stocks of companies such as ExxonMobil, BP, and Rosneft can rise when oil prices rise. However, not all companies benefit from rising oil prices. Airlines, transportation companies, and other companies that depend on high fuel costs can struggle when oil prices rise. Their stocks may decline as the cost of their products and services increases. Oil and geopolitics. Geopolitical events and decisions often lead to changes in the supply and demand for oil, which in turn affect the global economy and politics. Conflict and political instability in oil-rich regions can severely disrupt the supply of this resource to the global market. For example, wars and uprisings in Middle Eastern countries such as Iraq and Libya have reduced oil production and increased prices. Sanctions imposed on oil-producing countries can also have a significant impact on the global market. For example, sanctions against Iran and Venezuela limit their ability to export oil, resulting in supply shortages and higher prices. The Organization of Petroleum Exporting Countries, OPEC, plays a key role in regulating the global oil market. OPEC's decisions on oil production quotas can have a significant impact on prices and supply. For example, a reduction in oil production by OPEC members can lead to higher prices, which benefits exporting countries but hurts importing countries. Energy security is a major component of geopolitics. Countries seek access to reliable sources of energy to minimize dependence on external suppliers. This can lead to conflicts and tensions between countries. For example, disputes over pipelines and offshore oil transport routes can aggravate relations between states. The implementation of major oil and gas projects often involves active diplomacy. Countries involved in such projects seek to conclude favorable agreements and establish friendly relations with their partners. For example, the construction of the Nord Stream 2 gas pipeline has caused much controversy and discussion at the international level, as it affects the interests of several European countries and Russia. Conclusion: despite the challenges of the transition to a green economy and the development of alternative energy sources, oil remains an important financial asset. The future of oil as a financial asset is ambiguous. On the one hand, technological advances and the transition to a green economy may reduce the demand for oil and diminish its importance in the global economy. On the other hand, geopolitical factors and the role of OPEC may keep prices and interest in this resource high. Investors and companies should take these trends into account when planning strategy and managing risk. Ultimately, the future of oil as a financial asset will depend on the ability of the global community to adapt to new challenges and opportunities related to climate change and technological advances. Thank you for your attention, and see you in the world of finance.